It's been a long time since we've seen a sustained climb in prices, although this year has been pretty decent. Last 2 months in particular have been strong. Does that continue, or do we see prices go under pressure a bit?
Well, we've been through almost a 2.5 year decline in gold prices, and I think it's coming to an end. And not to get too technical, you have a basing pattern going back over a year now, and it's called a reverse head and shoulder, and that's as technical as I'll get. But it's a sign that the downside has been exhausted. So I would say that we're positioned for a new rise in the gold price.
Now, in terms of how you're invested, about 10% of the fund is in physical gold, then you've got about 86% in equities. Is equities the stronger way to play the market, especially if we are going to have a sustained rise?
Well, you're going to get more return from owning mining stocks. They are leveraged to the gold price. So when gold rises, mining stocks generally rise more. And the same is true on the downside. And so we have gold in the fund just to kind of maybe take out a little bit of the volatility.
So your fund, in terms of the average PE of the stocks you're holding, is about 35 times. So that's obviously more expensive than the overall S&P. Why is there a premium valuation?
The gold stocks are valued. You can look at those metrics, which people use for the S&P and conventional stocks, but what we look at is net present value, net asset value, which is more of a reserves in the ground. You make assumptions about future costs of producing, and you come up with a valuation relative to the market cap. And so if you look at that valuation, gold stocks are as cheap as they've been since I've been managing the fund, which goes back to 1998.